This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Tuesday, August 11, 2026, and this is the New York session. Now, let's get into it. The Fear and Greed Index has plunged to 14 out of 100, cementing a fear regime that is driving capital into the US dollar and gold. With the S&P 500 rally stalled and inflation data sticking, the market is bracing for a pivotal week. Looking ahead, the schedule is dominated by two major catalysts. First, today at 4:30 UTC, the Reserve Bank of Australia will announce its rate decision. This is a high-volatility event for Aussie crosses, particularly Aussie yen and Aussie dollar, as the Reserve Bank of Australia navigates domestic pressures against a backdrop of global risk-off sentiment. Second, and perhaps more critical for the entire FX complex, is the USDJPY report tomorrow, August 12. With headline inflation sitting at 3.46% and core PCE at 3.29%, any deviation from expectations will dictate whether the current fear narrative holds or fractures. Apex, how does this timeline shape the immediate flow?
It forces a binary outcome for institutional positioning. We see DXY leveraged funds adding 4,438 net contracts right now, effectively front-loading the bet on dollar strength. The Reserve Bank of Australia decision is a tactical flair. The CPI print is the strategic move. Until tomorrow, flows will remain defensive, prioritizing the safety of the greenback over growth-sensitive assets.
Let's set the scene. The Fear and Greed Index stands at 14/100. The VIX is subdued at 14.9, though it has been ranging between 14.77 and 18.43 over the last 5 days. In equity markets, we're seeing the S&P 500 rally stall as attention shifts to inflation. In Forex, the US dollar is the clear leader, pushing dollar-yen to 159.192 and lifting gold to 4,419.49. Meanwhile, euro-dollar languishes at 1.1543, and cable is essentially flat at 1.3511. Pulse, walk us through the macro drivers behind this divergence.
The macro picture is defined by a paradox. On one hand, real GDP growth is tepid at 1.5%, and unemployment is creeping up to 4.1%. On the other, the Fed funds rate is stuck at 3.63%, with the 10-year 2-year yield curve flattened to just plus 47 basis points. This compression tells me that while yields are attractive, the market is pricing in a slowdown. However, because inflation at 3.46% is still well above the Fed's 2% target, the restrictive tag remains on the dollar. That's why we see safe haven flows into dollar and gold despite the weaker growth data. The market isn't betting on expansion, it's betting on survival.
Several headlines are shaping this environment. Let's look at the key movers. First, MUFC notes that yen buying likely to stay more muted for the time being. Second, the S&P 500 rally stalls as US-Iran deal gets delayed and the focus shifts to the US CPI report. Third, gold extends the rally after the soft non-farm payrolls, but the US CPI could wipe out all the gains. And fourth, another cargo ship reportedly struck by the Houthis in the Red Sea. Grid, let's start with the yen comment from MUFC and the Houthi developments. How do these interact with the charts?
The MUFC observation is crucial because it validates the technical breakout we're seeing in dollar-yen. We're at 159.192, testing the 5-day high of 159.366. If yen buying stays muted, there's no mechanical buyer stepping in to cap that 159 level. The chart is showing clean momentum. As for the Houthi attacks, that feeds directly into the gold chart. Gold has moved from a 5-day low of 4,223.45 up to 4,419.49. Geopolitical friction keeps the bid under the metal, preventing any significant retracement even as equities stall.
I'd add to that on the yen side. It's not just that buying is muted, the positioning is extreme. Yen leveraged funds are sitting at minus 60,825 net contracts, with a weekly change of minus 6,143. That's an unsustainable level of bearishness. When Musk says buying is muted, it means there's no absorption of that short-covering fuel. If anything disrupts that flow, the liquidity vacuum could cause a violent snapback. That's the risk grid might be underweighting.
And that's exactly where I'm looking. The VIX is at 14.9, which is barely above its 5-day low of 14.77. Complacency is baked into the options market. You have extreme shorts in yen and euro combined with a suppressed VIX. That doesn't scream trend continuation. It screams latent instability. The fact that gold has rallied nearly 5% from its low, while the VIX remains flat, suggests the smart money is hedging for a spike that hasn't hit yet. If CPI misses dovishly, that negative 80,000 combined net short in euro, and yen becomes a liability, not an asset.
So we have technical momentum in dollar-yen challenged by extreme positioning risk. Let's pivot to the euro. The headline notes the S&P stall, but in FX, euro-dollar is at 1.15433, holding below the 1.15815 5-day high. CIPHER, what are you seeing in the euro flows?
Euro positioning is deeply negative, minus 52,205 net contracts for leveraged funds, but here's the nuance. Asset managers are net long at plus 219,262. There is a massive divergence. Speculative funds are piling into shorts, expecting further weakness, while long-only institutions are holding steady. This creates a fragile structure. If euro-dollar doesn't break 1.1581, those speculators have nowhere to go but further south. But any pop above that resistance could trigger a squeeze given the sheer volume of shorts.
Technically, the structure is clear. The 1.1581 resistance has held firm across multiple sessions. We are seeing bearish structure from the 1.15147 low. Buyers are absent. The ADP pulse was weak at 8.25K versus 15K prior, which reinforces the lack of buyer conviction. Until we see a daily close above 1.1581, the path of least resistance is sideways to down.
But don't ignore the broader sentiment. The fear index is at 14. Extreme fear often marks bottoms or reversal zones. While the technicals say sell, the sentiment data suggests the pain might be maxed out. However, until the CPI clears, the macro overhang of sticky inflation keeps the euro suppressed. The fear is real, and it's targeting emerging market flows and the euro equally.
Let's dive deeper into the primary mover, dollar-yen. It's at 159.192, up 0.02%. It's testing the 159.366 level. Grid, map the technical landscape.
We are seeing a structural shift. The break above 159 confirmed a shift toward higher yields. Immediate resistance is the 5-day high of 159.366. Volume is supporting this move, driven by the lack of yen buying. If price fails to hold above 159 after testing 159.366, we expose the pair to a rapid retracement toward the 158.5 pivot. But currently, the chart is showing strong momentum, not rejection.
I agree on the momentum, but I need to emphasize the source. This isn't just technical breakout, it's positional exhaustion. The yen shorts expanded by 61,403 contracts in a week. That is a firestorm. The momentum is fueled by deleveraging. Every pip-up is triggering stop losses. The risk isn't a slow grind, it's a cliff edge if those shorts unwind simultaneously.
That brings us to the synthesis. We have grid mapping the 159.366 resistance as a technical ceiling, but CIPHER showing that the fuel underneath is explosive due to the negative 61,403 contract change. Normally, I might flag this as a squeeze candidate, but Pulse, you noted the yield curve is flattened at plus 47 basis points. Does the macro support this aggressive shorting?
Not really. The flat curve suggests caution. A spread of plus 47 basis points is thin support for such an aggressive trend. However, right now the fear regime overrides the curve. Investors aren't looking for yield, they're looking for safety. They are shorting yen because they believe Japan won't intervene, and they are long dollar because inflation is sticky. So yes, the macro supports the direction, even if the curve width is thin. The trend is valid until the CPI proves otherwise.
Okay, so dollar-yen is a trend play backed by fear, despite a thin curve. Let's switch gears to dollar-CAD. It's at 1.39309, down 0.02%. Grid, how is the structure holding up?
This is a textbook range-bound exhaustion. We are trapped between the 100-day moving average support at 1.39256, which aligns perfectly with the 5-day low, and the overhead pressure at the 5-day high of 1.40379. Price is currently hovering just above support. Neither bulls nor bears can secure control here. It's a stalemate. The headline from Forex Live mentioned selling is capped vs a swing area, which matches this 1.39256 floor.
The flow data mirrors the chart. Unlike the yen or euro, Canadian dollar positioning isn't showing extreme skew. It's balanced. That's why we get this grinding range. There's no institutional aggression pushing it hard in either direction. It's reacting to the broader dollar strength, but it's not the epicenter of the trade.
I'd warn about the cap aspect. Grid, you mentioned the 1.40379 ceiling. Given the Houthi attacks and the oil-FX correlation, energy prices are volatile. If oil spikes on Red Sea tensions, dollar CAD could get squeezed upward quickly. The range feels stable, but it's brittle. A supply chain disruption headline could blow through 1.40379 instantly.
Fair point on the energy link. Now, let's look at gold. Gold is at 4,419.49, up 0.39%. It's climbed from a 5-day low of 4,223.45. Pulse, what's driving this safe haven demand?
Two things. First, the soft non-farm payrolls mentioned in the headlines. The non-farm payrolls declined by 23K month over month. That weak labor data fuels the narrative that the Fed might eventually have to cut rates, or conversely, that the economy is slowing. Both scenarios benefit gold as a hedge. Second, and critically, the fear and greed index at 14/100. When fear is this high, capital rotates out of risk assets and into tangible stores of value. The gold rally is a direct function of the equity market stall.
Technically, the move from 4,223.45 to 4,419.49 is a steep ascent. The 24-hour high is visible in the climb, but we haven't seen a major rejection candle yet. The trend is intact. However, remember that the headline also says USDJPY could wipe out all the gains. Technically, gold is extended. A pullback to retest the 4,350 area wouldn't be surprising if CPI comes in hotter than expected.
Look at the DXY correlation. DXY leveraged funds are net long plus 4,438 contracts. Gold is rising despite a strengthening dollar. That's unusual. Usually, a stronger DXY drags gold down. The fact that gold is bucking the DXY trend indicates that the safe haven demand is overpowering the interest rate sensitivity. That's a very strong signal. It means the fear trade is dominant over the yield trade right now.
Strong point from CIPHER. Gold is decoupling from the dollar temporarily due to pure fear. Let's touch on cable. It's at 1.35109, essentially flat. Why is sterling holding steady when the pound is often a risk barometer?
Because of the positioning anomaly, pound-leveraged funds are strongly bullish at plus 38,174 net. Despite the flat price action, smart money is loading longs. It's a classic fade the rally setup where crowd sentiment is bullish, but price isn't moving. It suggests accumulation. Sellers aren't stepping in aggressively enough to crush those longs.
Technically, 1.35109 is holding the 5-day low of 1.34343 comfortably. We've got a defined range between 1.34343 and 1.35308. It's tight. The lack of movement confirms the consolidation. Without a catalyst, it's going to drift sideways.
Don't forget the UK labour market uncertainty. The headline says the UK Stats Office to only decide in July next year on plausibility of transition. This ambiguity keeps investors cautious. They aren't dumping the pound, but they aren't chasing it either. The static price reflects the static political/economic outlook.
Apex tie this together. We have dollar-yen trending higher on fear, dollar-CAD range-bound, gold bucking the dollar due to extreme fear, and pound consolidating. How do we navigate this?
The overarching theme is defensive positioning. CIPHER highlighted the massive yen short buildup, which Grid identified as technically validated but fundamentally risky due to the thin yield curve. Pulse correctly pointed out that the fear regime is overriding growth concerns. My synthesis is simple. The market is front-running the CPI print by selling yen and buying gold/dollar. The danger lies in the crowding. As CIPHER noted, the negative 80,000 combined net short in euro and yen is a liquidity trap. If we see dollar-yen fail to hold 159.366, or if the VIX breaks above 18.43 as SPECTER warned, that crowded trade could reverse violently. For now, the trend is your friend, but the margin for error is razor thin.
To summarize, the US dollar is commanding the field, driven by a fear index at 14/100 and sticky inflation. Dollar-yen is testing 159.366 with heavy short positioning lurking beneath. Dollar-CAD is confined in a tight range between 1.39256 and 1.40379. And gold is rallying to 4,419.49, decoupling from the dollar as a pure safe haven hedge. Tomorrow, the USCPI report will test the resilience of this fear regime. Stay disciplined, watch the levels, and manage your risk. I'm your host, ShadowQuant. Thanks for listening. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Forex Edition. Stay tuned for the after-hours session where we will see how these calls play out. Until then, trade safe.